There is a supply-demand perfect storm brewing in this specific commodity that will mean life-changing gains for well-positioned investors. While the rest of the commodity space has collapsed during the bear market, this commodity has nearly doubled since 2008. Not only will this resource be a hedge against inflation, but a solution to feed an exponentially growing global population expected to reach 9 billion people by 2050. This is the one resource stock to research right now. Learn more at futuremoneytrends.com/demand. Greetings and thank you for joining us at futuremoneytrends.com. We have an amazing show and guests for you guys today. The topic is going to be silver, but from two very different standpoints. David Trungale of TraderTours.com. He has been very bearish on silver and has really nailed this market for the past few years. He has successfully shorted silver along with his subscribers for years now. And last we spoke, silver was at $15 and he was still very bearish for the technical analysis side of silver. We also have Gary Christenson. He is the host for the deviantinvestor.com. Deviantinvestor.com. My goodness, one of the best gold and silver analysis websites that I've ever been to. I love it because he has original content, and I so appreciate that because it's not just another aggregator of the same old. Gary always comes up with new views, new analysis, and he believes silver is going much higher, north of $50 in the near term. Gary and David, thank you so much for being with us. Gary, thank you.
Welcome.
And David, thanks for being on the show.
Of course, Dan. Thanks for inviting me.
All right. Well, here, let's start off with you, David. David, you've been right on the silver bear market for many years now. You've successfully shorted it. And the last we spoke, it was at $15. It's rallied significantly. Gold's at 52-week highs. The mining shares are 52-week highs. Silver's at 52-week highs. So my question to start off was, are you still bearish? And if so, what do you call the rally we just saw? At what point is enough for you to become a bull, a technical bull?
Well, when you say I've shorted silver successfully, you're correct, and that was up until 2016. Now, there's no denying that silver's had a nice pop here. And as a short-term trader, I agree that it would have been a good play. It's something that I missed out on. That does not take away from the fact that silver has still been absolutely annihilated since the peak of the bull market, and that was topping out in 2011. Okay. Now, Dan, when I first was on your show years ago, I said that markets were irrational, and that's not 100% accurate. I do think there is a fundamental reason as to why silver has been falling, and that is because the inflation rate has been falling, specifically since 2011. Now, I don't want people to get irritated when I say that. I'm not denying that inflation has not existed. It has. Again, I'm talking about on an annual basis relative to where we were in 2011. The inflation rate has been falling. And I don't care if you use the government CPI, or I don't care if you use John Williams' Candle Stats numbers. Fact remains that the inflation rate has been coming down. So I consider this still a rally within a long-term bear market. I think we're hitting some resistance right now. I could be wrong. If it does go a little bit higher, longer term, my view could change. But again, until silver can get above 20 or 25, I still consider this a bear market.
Yeah, and I do want to let subscribers and listeners know, David, we have talked about this in the past. You are not against or for silver. You really don't care, to be honest, correct? You're just a trader. You're just looking at it from your technical analysis, correct?
That's correct. I'm trying to capitalize on trends. So again, if you look at silver from 2000 to 2011, it was a wonderful buy. Same thing with the 70s. And I think that was because it was specifically hedging against inflation, especially in the 70s. We had double-digit inflation. But again, I think what's happened here is everyone that was anticipating this dollar crisis, it didn't happen. And that was why the commodity markets peaked out. And you might say, well, wait a minute, the Fed's been printing money like crazy. That's true. I'm looking at a chart of the monetary base right now. It's quadrupled over the last several years. And I think that they're doing this because they're trying to actually resist people defaulting on loans. Okay, they're fighting the debt. And that sort of canceled it out. So the other thing I would like to clarify here before we turn it over to Gary is money printing does not create inflation within itself. You hear people say that money printing is inflation. It's those dollars actually going into the economy and being spent on consumer goods or services. That's inflation. So if I was at my kitchen table right here and I had a printing press, and I printed up a whole bunch of money, that wouldn't do anything. Okay, so it's important to know where that money's actually going. Well, the fact remains that I think the longer-term threat is deflation and not hyperinflation.
Yeah, and for any listeners, there's price inflation and inflation. The two terms often get combined. Inflation is just simply put the expansion of the money supply. But most of the time, I would say 90% of the time when people refer to inflation, they're actually referring to price inflation, which is actual prices going up. So Gary, is silver hit essentially some resistance here because this is just a rally within the long-term bear market that silver's been in?
Well, no, I don't agree with that at all. First of all, I want to say, David, thank you for your comments. My ultimate conclusion is very much different from yours, but many of the pieces along the way I agree with. I do think that inflation rate is only one factor to consider, and I do agree with you that printing money in and of itself doesn't create inflation, but once it gets into the economy or once those dollars come home, that does create inflation. So we're in agreement there. And I do agree that creating massive amounts of dollars, as in you talked about the monetary base, does fight debt. We are in a deflationary environment in many respects, but just because we have deflation in some areas doesn't mean we have deflation in all areas. We could see, for instance, the Dow and the bond market collapsing and gold and silver spiking higher. Pretty much the opposite of what's happened for the last 5 years. So we have deflation in one area and inflation in another area. But all of that said, I'd like to approach this from a slightly different point of view, and this is why I end up with a bullish analysis and why David ends up with a bearish analysis in regard to silver. And my whole point is, I want to go back and, although I am a technician and I do like technical analysis, I think it's been less effective for the last 7-8 years, thank you to all the market interventions by central banks and governments. So I go back to look at history, and I try to see history and human nature and politics and central banking. And the conclusion I come from that is debt is going to increase. We had $3 billion in 1913. We got $19 trillion now. Money supply goes right along with debt. They're going to increase. And along with that, the general price trend is going to increase with massive ups and massive downs below and above trend. Same thing with gold and silver. So then the conclusion I come to on that is silver's 58 cents 100 years ago. Now it's, say, $17. Prices are going up. That's just not the nature of silver. That's the nature of the devaluation of the dollar. And that's going to continue as long as our current economic system exists, debt-based fiat money. I believe that will continue. We'll have highs and we'll have lows in the price of wheat. We'll have highs and lows in the price of cigarettes. We'll have highs and lows in the price of silver. So the question then becomes, what is a high and what is a low and how you determine it? And that's where I go and look at ratios. And if you take the gold-silver ratio or the inverse, the silver-gold ratio, you can see that it's at, for all practical purposes, the gold-silver ratio is at a multi-decade high. It hit about 100 a decade ago, and then now it's about 80, and it's just come down from that. That has always been, and I say always for the last 40 years, a very good indicator of silver bottoms. And the indication then is that silver then launches onto a massive bull market for several years. Another ratio I use is silver to national debt. If you look at national debt and plot it since, say, 1971, and you plot silver on a similar log scale, you can see that both are going up exponentially. And you can see that when you plot them, you see silver spiked out way ahead of national debt in 1981, came down hard after that, then spiked out way ahead in 2011, and has come down hard since then. And I believe that silver prices will regress to the mean being the increase in national debt. Another ratio to use is silver to the S&P. Same thing, same process. Silver is very low compared to the S&P now, like it was in roughly the year 2000, and it was too high in 2011. I believe silver will rise to the top of that channel again, all of which tells me that we're having an exponential increase in prices, an exponential increase in debt, and an exponential increase in silver. And right now, silver is low compared to all those exponential trends. So that's why I think it's likely to pop quite a bit higher. And I'm not saying next week or next month, but I'm saying in the next 2 years.
I'm talking to David Trungale of TraderTours.com and Gary Christenson of DeviantInvestor.com. We're talking about silver today. So, David, Gary has just brought up some additional technical analysis, some additional analysis. Do you also look at that just to try to give yourself an edge, or is it just the silver chart?
No, it's all of the above, Dan. I mean, now specifically, again, I'm a technical analyst. That's my area of expertise. So, I'll go ahead and step out of my trading shoes again. And again, I disagree with him longer term. Now, what's critical here is what is the long term? Silver has collapsed over the last 4 or 5 years. I don't consider that a short-term move. I mean, anyone who bought silver over the last 4 or 5 years has gotten crushed. Now, in the very long term, if we go out like 30 years in the future, I would agree that on a giant scale, because silver has fallen so hard, yeah, if you bought it here at 17 an ounce and sat on it for decades, there's probably a pretty good chance you can maybe double your money or so. But again, I don't look that far into the future because at some point all of us are going to be dead here. Now, the other point I wanted to counter Gary, I agree with him. When you have these debt bubbles and they pop, things don't go so good. But the question I wanted to ask him is, if you look at all of these historical debt bubbles, whether it was the '08 crisis, the Great Depression, every single one has resulted in a contraction in the currency and the market pops. So why would this next bubble be any different? When the debt bubble pops, why would it result in hyperinflation?
Well, and that's a very good question, because if you look at popping bubbles, that usually means deflation. We have too much debt, it pops. That bubble pops. We have the S&P at too high a multiple of earnings, that pops. That means those prices come down for the value of the debt and the value of the S&P. That's right. The bubble implodes and comes down. But do you really believe that the central banks are not going to go into hyperdrive just like they did in 2008 and print and print and print to try to keep the bubble inflated, to try to save their cronies and to try to save the banking system as they see it, starting with themselves first, of course?
They're not going to. They are going to print, Gary. They are, but it's not going to result in hyperinflation. Because if it did, and this is another point I brought up here on my YouTube channel, the banks, if they printed the dollar worthless, they would be the ones losing relative to the American consumer. All these people that are loaded up on credit card debt, student loan debt, or fixed mortgage debt, these people could go on the streets and pick up worthless dollars and pay off these debts free and clear and basically screw the banks over. So again, the banks control the currency. They're too big, too strong, too smart. They're not going to destroy the dollar. They would much rather see the economy collapse than print the dollar worthless and trying to save the economy.
One thing with hyperinflation, for everybody listening, hyperinflation is also, it's essentially a loss of faith in the currency. So hyperinflation, though we always think of just this massive money printing and wheelbarrows of cash, hyperinflation can come from just the loss of faith in the currency, where the currency is rejected. But David brings up a very strong point about that the powers that be, the people who control essentially the world, the oligarchs, the dollar has been their tool. So for them to destroy their main weapon of choice against other economies and the whole world, it is somewhat of a suicide, unless of course there is a plan post-dollar to have something even worse. But Gary, you have called for. You have stated that you think that hyperinflation is in the cards here. At what point in time, or what would it take for hyperinflation to happen to essentially the only reserve currency in the world? I know there are others that call themselves reserve currency, but the U.S. is when the dollar is king, and it is backed by a very powerful military, first world economy, first world infrastructure, and 4,000 or 5,000 nukes. Okay,
well, good question. But before we get to hyperinflation, let's go back to one more thing. David made the comment that the powers that be, and I'm interpreting here if I've got it correct, that the powers that be would rather destroy the currency than destroy the dollar. David, is that more or less what you said? I mean,
no, I'm just saying that
the dollar.
Right, they'd rather see the economy fail like they did in '08. And yes, they printed money to revive it, but it didn't result in hyperinflation. So I'm not denying that they're going to try and interfere with the crash came, and I'm sure it will at some point down the road. I don't deny that. That's the fundamental dispute between the Keynesian party and the Austrian. So yeah, they are going to interfere, but what I'm saying is it's not going to be to the point where the dollar is worthless. I mean, they control the press, and they have a better idea as to where the currency supply is than people think. You know, this is why in Zimbabwe we had, the government was small there. They weren't even calculating the CPI or tracking the inflation rate at one point. So what I'm saying is the Fed, they control the currency, and they are not going to risk printing the dollar totally worthless. If it gets to the point where inflation's out of control, they would much rather see the economy fail than print the dollar worthless.
Gary?
Well, I agree with you that they don't want to print the dollar worthless. But I think that we're looking at this too much in a black and white viewpoint. Suppose it's just a matter of let's just devalue the dollar like the euro, like the pound, like the yen, a few percent, 5-10% a year, and try to smooth everything out with that and save the economy for the benefit of the powers that be by doing that, rather than a falling off a cliff kind of devaluation. Let's just try to keep, from the point of view of powers that be, let's keep it smooth. We don't want any sudden movements. We don't want any falling off the cliff kind of devaluations or falling off the cliff kind of crashes because, as Dan pointed out, and I think this is a very important point, confidence in the currency is critical. If I don't have any confidence in the dollar, I might go out and buy euros or yen, or I might go out and, worse yet, buy silver or gold or land. So if we have crashes in the currency, crashes in the S&P, people lose confidence, and that's the real thing that the powers that be, must maintain is do what you have to do to keep the confidence in the currency strong so that people don't lose it, because the fundamentals of the dollar are like the fundamentals of the euro and the yen, terrible. But right now, confidence is still fairly good in both. So then to get on to the next point of what would bring on hyperinflation, well, we all know that you can do Zimbabwe or Weimar printing, but probably that's not really the stimulant that would start it. I'm thinking decline of the status of the petrodollar. If petrodollar weakens or the petrodollar disappears because, say, Saudi abrogates that agreement or starts accepting payment in yuan and euros, there's no longer a need for dollars in the world as much as there is currently. A lot of those dollars will come flooding home because people will sell them, not need them, and that could really produce a hyperinflationary pop in this country. There's a lot of other things that could, but that's the number one thing that I'm thinking of right now. So I'll turn it back over to David.
David, real quick, you in a video you did last week, you talked about Mike Maloney with silver going to $7. You reiterated your $12 silver call. When it comes to deflation, I think the natural force is deflation. I don't think many people deny that. However, all tax revenues are tied to inflation, government spending, government debt. It's all they're inflation dependent, and deflation would blow the whole damn system up. So, do you see deflation ever beating the man-made force of inflation? Because it sounds like you do believe that deflation will occur, but I would say my question is how can it occur when the whole world is it's like a must win? They cannot allow deflation. Deflation bursts the whole damn thing. And then you might have hyperinflation anyway, because if the whole damn thing bursts, no one's going to want any of these paper currencies.
Yeah, well, again, I don't see hyperinflation happening, but as far as deflation goes, it has happened. It happened in '08. Yeah, that wasn't the prolonged deflation that we had during the Great Depression. That was the Great Depression is the most notable example here in America of a deflationary crisis. And it happened, and it took a long time to recover. Also, Dan, I don't think anyone, whether you're a libertarian or not, I don't agree, or I should say I don't think anyone would disagree with you that inflation exists in the long run. Anyone can pull up a 100-year chart of the dollar and say, the dollar's been going down in the long term. But again, these 4 to 5 year collapses, which is what we've seen in silver, that's super important to play those trades. So again, it all comes back to how do you define the long run? Okay, again, the dollar, it bottomed in 2011, at least temporarily. But again, that was 4 or 5 years ago. The dollar's had a huge move here up. So those moves are very important to play. And I'm not saying the dollar won't go back down again long term, but until further notice, I would say cash is king. Now, the other thing, and this is just putting all technical indicators aside and all fundamental analysis aside, part of being a true contrarian is doing the exact opposite of what everyone's saying. So you have the two camps here, deflation and hyperinflation. Well, what's realistically happened over the last 2 years? Yeah, the Dow's been consolidating, U.S. equities are cooling off. I agree that they're not a good long-term buy right now. But look at the inflation rate. It's been next to zero. It's been 0 to 1%. And the U.S. equity markets have been going sideways. So we haven't had deflation or hyperinflation. In reality, we've had a sort of a stagnant, neutral, choppy market. So that trend, that's another possibility, is things may just kind of continue this way for a while. It's not that the Dow has to skyrocket up or collapse overnight, but again, we'll see. So bottom line, though, it all comes back to how you define the short run or the long run. I mean, you could have bought silver at the peak of the bubble in 1980 at 50 an ounce, and you could have held it for, 30, 40 years, and you still would be way underwater here due to the recent collapse.
Yeah, I think only a handful of people bought it at that price. It was a massive spike. I think people should understand that.
That's true, but there were some people, though.
Yeah.
I mean, for every buyer, there obviously has to be a seller. And one last point here. When something comes collapsing from a high point, it's always going to be a little difficult to recover. And like you said, it's not that everyone bought at the top, but a fair amount of people did. If you go back in 2011 and look at these videos that were making, they're going viral all over the internet and even on the news, you had people all rushing into gold and silver because they said the dollar crisis is going to happen. And the public is usually wrong, okay? And that creates a bubble, and the bubble pops. But as silver attempts to get back towards 50, first it has to break 20, then it have to break 30. You have to take it one step at a time. But as it continues to go up, there are going to be people that are going to sell into those rallies and sell into that strength because, again, we know people somewhere were buying silver at 50. For every buyer, there is a seller. So those people were hurt bad. And the same principle is true with individual stocks. So that's why stocks like AIG or Citigroup are probably never going to recover, maybe not even in our lifetime. I mean, these things have collapsed like 95%, and there were people that bought at the high point and got hurt. So as the thing attempts to go higher, you're going to have people sell into those rallies just to get out and to knock it back down. So I can't give you an exact assessment as to where silver will be by the end of the year, but I am about 95% sure it's not going to be anywhere near 50 or let alone 100.
Gary, does gold and silver need inflation to rise? Because for the past 3 or 4 years, they have not done so well during a deflationary situation in commodities.
They don't need consumer price inflation to rise, and you can go back and prove that through history. Again, on long-term, 4, 5, 6 years period, not day by day or week by week. No, they don't need inflation to rise. What they need to rise is a choice of moving from paper assets, Citigroup or whatever, to something hard, silver and gold. And that's what you need is a choice. You need a lack of confidence in the dollar. You need a lack of confidence in the existing financial structure. You need to worry about the PE ratio on the S&P and say, I don't think I want to have my money here anymore. Those kinds of things all are going to weigh. And in 2011, they were pretty well all weighted against the price of silver going higher. And now I think they're pretty well all weighted in favor of the price of silver going higher. Look at the investment demand for silver eagles. It's gone substantially higher because people realize this is a better place to be right now. The price of silver, if you look at a long-term 25-year trend and put the exponential trend on the price of silver, in 2011, the price of silver was more than double that exponential trend. And now it's, I shouldn't say now, but December of 2015, it was about half of that exponential trend. Things regress to the mean, and the mean is an exponentially increasing price over a very long term. 2011, silver got way too high, and it got trashed since then, absolutely killed. And anybody who shorted silver in 2011, my hat's off to them. I didn't short it, but I didn't buy any either. that regression to the mean thing is important. You go too high too fast, it's going to collapse, and it does collapse. And of course, nobody at the powers of B level want to promote silver and gold, so they've got a natural headwind anyway, move 4, 5, 6 years. And I don't know that we're going to see $50 silver in the next 2 years, but I would expect that it's a reasonable shot at $50 silver by the end of 2017. But that's just guessing at this point. I'm just saying, regression to the mean, it's way too low now, and it's likely to rally higher.
I want to ask you guys both the same question. David, what do? You have a very strong opinion on your analysis on silver. What do you do to hedge your position? And also on a side note, because I know you are libertarian, this has nothing to do with the trading of silver, but do you buy physical coins for any reason?
Not recently. I did in the past, and that was specifically because precious metals were in a bull market. But again, I don't see it as this insurance hedge that everyone else does. Again, it's a commodity. It's volatile. Again, that doesn't mean you can't trade it. I mean, like I said, Dad, at the beginning of this call, buying silver and gold this year was the right move. It was. It was a double-digit return. It was a good short-term play, and the key word is short-term. So again, I mean, now we're probably going to get knocked down again, or even if we don't, maybe the bottom is. I've called for silver to go below 12. Even if it doesn't happen, we may kind of just screw around at this support level and bounce around between 13 and 20. Now, again, this has to be timed properly. And again, I'm not buying physical coins, gold or silver at this point.
Gary, what do you do to hedge your position? You're bullish on gold. Do you do anything to hedge your position?
Frankly, no, because if I were hedging, and I'd be doing I'm not doing these, but things I could do would be I would short ETFs or I would short gold stocks or something. But I don't want to do that. I am convinced that we're going to see massive rallies in gold, silver, and the stocks, and so I want to be long those things. So all I'm doing is I'm not buying right now because I'm expecting a pullback in silver and gold and stocks. Not totally convinced it'll happen, but expecting that the probability is weighted in favor of a pullback. And at this point where it pulls back, I'll put more cash into those things. Right now, I'm not buying. In 2 weeks or 2 months, I probably will be. And I won't be hedging because I think that we're going much higher.
The metal mining companies have significant gains since September of 2015. And then a huge run here in 2016. I mean, many of them, the good ones, are at 52-week highs. Some of them have actually recouped amazingly. There are a few out there who've recouped almost all their losses to the downside from the past 3 or 4 years now. These companies, I've talked to Rick Rule in the last few days. He believes that we have reached the bear market bottom, that it's over, that the birth of the new bull market has started. From your technical analysis and from your opinion, David, I want to go to you first. What are your current thoughts on the mining shares themselves, junior or senior, doesn't matter, just the mining shares in general?
Well, again, I mean, it's not really my cup of tea just due to the trend. I mean, like I said, it was a good short-term play, but looking at the GDX right now, I'd be pretty surprised if the skyrocket back up to the 2011 levels. I think things are a little bit overheated now, and we may pull back. Now, again, as far as the bottom being in, I mean, time will tell, and I could be wrong. I mean, maybe the bottom isn't, but it doesn't always guarantee that's a good buy because, again, if you look at silver after the 1980 collapse, it consolidated at the single-digit price range at about $4 or $5 an ounce, and it sat there for 25 years. So again, I'm not saying that exact same thing is going to happen. I'm just, again, looking at things from a technical level, and after things fall from a high point, it's always going to be pretty difficult to recover. Again, that doesn't mean these markets can't be traded. So I don't want anyone to read me wrong and say there aren't short-term opportunities. There obviously was, both the GDX and various miners, as well as gold and silver. But again, I don't consider this a screaming buy, and I don't think that the mining sector or the commodity markets are going to skyrocket back up to their 2011 levels.
Gary, what are your thoughts on the mining shares right now?
Well, first of all, I have to say I respect David, and respect is what I consider intelligent analysis. I disagree with him substantially. I think the mining shares are going to go much higher, and I think they are going to do crazy things that people don't believe in terms of going up. They've been repressed and pounded for so long that they're due to move up, and I believe they will. One other point about, yes, 2011 was a huge up move in the price of silver, but if you go back and look at it historically, in terms of standard deviations off the trend or whatever else, ratios to national debt, other kinds of things, it was just a little blip. The 1980 blip on silver was a huge, major, catastrophic, generational move, and that's why things took 25 years or 20 years to recoup. I see silver from 1980 to 2001, that was 21 years to recoup its, to consolidate and start to build a new base. I think that 2011 wasn't nearly the price spike that 1980 was, and 5 years is plenty. I think we should have 5 years from now of going up, and perhaps a lot more than that. But that's just my assessment on silver. And then the silver shares and the mining shares, gold and silver mining shares, will be that same thing except multiples higher. I expect them to be much, much bigger ratio moves than the actual physical silver.
Gentlemen, I know David from TraderTours.com is a day-to-day trader and technical analyst, and then Gary of Christenson of the Deviant Investor, you are a long-term. You take the long-term approach, but for the entertainment of the audience, I do want to end this interview with some December 31st, 2016 silver and gold calls. I'll start off. And again, this is, no one's going to be coming out with a video just so, in 9 months from now that you made this call and any of one of us were wrong. We're doing this for fun. It's very speculative, trying to make a pick, especially on a date, but we're just giving it our best guesstimate. I believe silver, come January 1st, 2017, will be somewhere north of $20 per ounce, 20 to 25, and gold will be north of $15.50. David, where will it be?
Probably about the same level they're at right now. So again, maybe silver 17, maybe 15. They'll probably consolidate. Gold, I would say maybe around 1,200 or 1,300.
Gary.
My pick, and again, you prefaced it by saying we're just speculating here. My pick for gold will be 15 to 1,600, possibly a little higher, and silver 25 to 40.
Interesting. David Trungale of TraderTours.com. You guys can get a subscription there at TraderTours.com and successfully trade not just the silver market. This is one of many things David does. We will never forget the amazing Disney call he had on our show a few years ago. So he also trades many of the blue chips. In fact, David, I would say silver is not even your main thing that you guys prefer to trade. You're mainly trading blue chip stocks, correct?
It all depends on the market, Dan. Right now, I agree, because the Dow Jones is consolidating near a high point. I've gotten a lot more defensive recently. The breakaway gaps and the resistance breaks that I was using for technical buys in 2013 and 2014, that hasn't been the same strategy. This year, again, my market portfolio had started to go the wrong way, so I said, all right, I got to make a change. And that's how I think everyone should approach the market. If something's not working, time to make a change. If it is working, add to your position. So yes, my advice, stay defensive. You could go into some dividend plays this year and hold plenty of cash.
All right, that's TraderTours.com and Gary Christenson, DeviantInvestor.com. David, Gary, how often do you post on your website?
Actually, usually only twice a week. It's variable, but that's what I average, is twice a week.
But it is all original content. It's great. You can also get an ebook. What is the ebook called, Gary?
The ebook I have out, Gold Value and Gold Prices, 1971 to 2021.
Yeah, is that the book you did? I remember a presentation you did at the Liberty Symposium. Was that research and information based off of from the book?
Yeah, well, actually, it went the other way. I did the research, did the symposium, and then thought, well, this went over well. People liked it and appreciated it. I'll write a book and put it out.
It is absolutely fascinating, everybody. There's just nothing else out there like that, and he's taken the time He's basically laid it all out. So deviantinvestor.com. Thank you, gentlemen. I look forward to talking to you guys again real soon. I appreciate your time.
Thanks, Dan, and thank you.
All right, guys, we're all done recording.